Hello everyone, welcome back to All Financial Discussion channel. For this video, there are actually two objectives. The first objective, I'm going to explain how can we actually use PE ratio, price to earning ratio, to pick the best Singapore bank stock. For example, we have DBS, we have OCBC, and also UOB. I'm going to use price to earning ratio to justify the pick in 2026. So this will be the first objective. My second objective, I will be explaining why DBS price to earning ratio actually increased. So this will be the objective of this video. Guys, before I continue, I'd like to urge you guys to help me by like this video. Guys, it's free and just a few seconds. Help me press the like button now. For those who are new to this channel, please consider to subscribe and turn on your notification bell. Once again, thank you so much for strong support. A quick disclaimer, this is not a financial advice. Please conduct your own independent research and consult a professional if needed. Never invest more than you are willing to lose. With this, we are ready to kickstart today's discussion. I still remember when I actually started work, which is many years ago, maybe around 30 years ago. I still remember during our lunch break, our senior actually discussed on investment. So basically their advice is to invest into Singapore banks, the top three Singapore banks in Singapore, which is DBS, OCBC, and UOB. Even now, I think that their advice is still relevant because it is still very attractive to invest into the top Singapore three banks. So later on, I will be using price to earning ratio to determine which bank is still a good buy or maybe a better buy. But before I continue on the price to earning ratio, I like to say this, it is always very important to have additional metrics to determine which bank is still a good buy. For example, ROE, return of equity. Okay, so basically this will tell the banks is still profitability and also how efficient they actually turn our investment into profit. Next will be dividend. When we actually buy the share of the bank, the key objective is to earn a passive income. So therefore, the dividend yield is also another important parameters for us to judge which bank, in fact, will be a better buy. Next, non-performing loan. Okay, so like the name imply, this actually will let us know, okay, how many so-called credits will be default or near default. So this is also very important for banks. Last but not least, in terms of the loan growth, so this will allow us to anticipate the future earning growth. This table here show the two types of price to earning ratio for the three Singapore bank. I have the trailing PE ratio and also the forward PE ratio. What can we actually tell from this PE ratio for the three bank? DBS has the highest PE ratio. This simply indicates that investors are willing to pay more for every dollar of earning. This also suggests that stronger growth expectation or a premium for its size and diversification, okay, making it the most expensive of the three on a value basis. Okay, so basically we conclude that DBS has the highest price to earning ratio, but they are considered premium, but investor has great faith in terms of the growth expectation. Next will be OCBC. So OCBC sit in the middle. Okay, they actually has a balanced valuation. Okay, so like I mentioned earlier on, OCBC is actually in between DBS and UOB. Many investors view OCBC as a balance between valuation and earnings growth with solid performance in fee income and wealth management. Last but not least, UOB have the lowest price to earning ratio. This implies that it is actually the cheapest valuation among the biggest three. A lower PE, in fact, can indicate a relative value opportunity but it may also reflect slower growth expectation or higher perceived risk as compared to its peer. So in short, from here, okay, so for some may not want to buy DBS because the PE ratio is quite high. For some, they will be very worried about UOB in terms of the growth aspect, while OCBC sitting in between DBS and UOB. Now, we like to draw a very simple conclusion. Which bank should we buy in terms of price to earning ratio? So the answer is it actually depends. Okay, so basically there is no absolute answer. It depends on what you are looking for as an investor. For example, okay, so if your goal is actually equals to the best value, okay, which is the cheap entry, then probably UOB will be your choice because UOB actually has the lowest PE ratio. So basically, this assumes that all the fundamentals are actually sound. So basically, UOB is often appeared cheaper on price to earning ratio as compared to the other two, and this can be seen as a value play, especially if you believe that earning will rebound or credit costs normalize. Next, if you think that your goal, your objective is to have the best growth and in terms of the quality, then probably DBS will be the one that you can choose. But you must be willing to pay for a higher price to earning ratio. DBS higher valuation actually suggests that investors expect more growth and perhaps more resilience business diversified. The higher price to earning ratio actually reflect their premium. Last but not least, if your objective is to balance and to have a lower in terms of the volatility, so basically your choice will be OCBC because they actually sit in the middle. And historically, okay, OCBC has delivered solid fee income growth and also the returns. For me personally, I think that DBS price to earning ratio is too high. So probably I will buy, okay, if there is a correction. So basically, this is for DBS. As for UOB, okay, I'm a little bit concerned in terms of the growth aspect. So basically, I will not buy so much of UOB. I mainly will focus on OCBC because they are actually balanced in between DBS and UOB. However, like I mentioned earlier on, it is always good to diversify. So for me, okay, I probably will have about 50% on OCBC, 30% on DBS, and 20% on UOB. With this, before I continue, why the price to earning ratio for DBS actually increased, I need your help, guys. I need your help to help me by like this video. Guys, if more of you guys actually help me to like this video will have a better chances to reach out to a larger audience. So guys, help me. Press the like button now. For those who are new to this channel, and if you have learned something from this channel, seek your help to subscribe to this channel and turn on your notification bell. Once again, thank you so much for strong support. Now, let me explain why price to earning ratio of DBS actually increased. So this is actually the formula for price to earning ratio. In order to keep this price to earning ratio a big number, the share price must be big, and also on the other hand, the earning per share must be small in order to achieve a big price to earning ratio. Let's go in depth why DBS actually has a high price to earning ratio. There are actually three reasons, okay, why price to earning ratio of DBS actually increased. The first reason is DBS share price has rise strongly. As you can see from this chart here, you can see that DBS share price has been near record highs in recent months. This is because of strong investor confidence, dividends, and also the overall banking sector sentiment in Singapore. This is what I have discussed on my previous slide. Because the share price has been all-time high in recent months, so therefore for DBS, the price to earning ratio actually increase. Second reason, DBS earning growth has been slow. So in fact, you can see a straightforward impact in terms of the share price. You can see that there is a correction recently because of weaker growth for DBS. DBS in fact reported net profit, okay, what was modulously low or flat in some period due to challenging such as lower net interest income, okay, because we know that interest rate actually dropped, and also higher costs and also tax. If earning per share grows lower than investor expected or fail to beat expectation, that actually contribute to a higher price to earning ratio since the earning didn't keep pace with the rising share price. So in fact, this is a news article from CNA. Okay, Singapore Bank DBS Q4 net profit missed forecast flat rate headwinds in 2026. So this is the second reason why DBS price to earning ratio actually increase. The last reason, market expectation is still optimistic. Okay, so basically, I want to remind you guys that share price is in fact forward looking. So now, even though the earning was slightly below the forecast in a quarter, investor might still buy the stock because they expected future earning to recover or in fact grow. Okay, so basically all this is because of dividends, buyback, or rebounds in margin. This outlook can push the price up faster than current earnings. This forward-looking optimism can actually raise the forward price to earning ratio even if trailing earnings are flat or weak. Okay, so basically, like I mentioned earlier on, because share price is forward-looking, because investors still has good faith on DBS, so therefore they are willingly to invest even though the share price is high. So when the share price is high, price to earning ratio is also high, but investors still have the confidence to invest into DBS. So therefore, this actually caused the price to earning ratio of DBS to increase. With this, I'd like to end my discussion. Please help me to like this video and subscribe to this channel. Once again, thank you so much for strong support. I hope to see you guys soon. Bye for now. Thank you so much.